Okay, folks, welcome back. This is price action model number 2, short-term trading plan, 50 to 100 pips per trade. All right, so ICT price action model number 2, short-term trading model. And again, the objective is 50 to 100 pips per trade. As I warned in the first price action model, majority of the slides you see in these trade plans are going to be repetitive. So please avoid sending me emails. There are differences. You just have to pay attention to the logic that's being submitted in each one. The process, obviously, for every trade plan is we go through a preparation stage, an opportunity discovery, the trade planning, trade execution, and trade management. In the preparation, we always refer to the economic calendar for the coming week, noting all medium and high impact news events for the markets that we intend to follow. We study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. In a simplest way of describing this process, what we're doing is we're looking for a collection out of the weekly templates that I outline that are bullish when we're anticipating the market to go higher. And by comparing the bullish templates with that of the calendar, you can match up what the likely weekly profile is going to be. Now, it's not going to be 100% based on just that, because there's always a variable. But that's what I do. I go in and look at, if I see a high impact news event that's really centered on Tuesday, London Open, then I'm going to be looking at the Tuesday low of the week weekly profile, and or the Wednesday low of the week weekly profile. All right, so we're going to be looking at the preparation. We're going to be determining the IPTA data range for the last 20 days. We do not count Sundays. We note the highest high and the lowest low of the past 20 days. And this is going to be your current dealing range. So if today is whatever date it is, we're going to look back 20 days from today. And whatever that trading day is, that is your 20-day ago look back. We're determining the highest high and the lowest low, and that is our dealing range. Now, you're going to sometimes encounter periods where you may require looking back 40 days or 60 days when you have really no PD arrays to choose from in the last 20 days. In other words, if we've already worked inside of the last 20 days dealing range, both up and down, then you would use the look back of 40 days. And if the same thing, if we have nothing in there, we worked both directions, we go back to 60. If you can't find anything in the 60-day look back that's clear and logical, then you're going to have to choose another market to trade or sit on your hands. Inside this dealing range, we look for the next draw in liquidity. Where is price likely to trade to next? An old high, low, fair value gap, or liquidity pool. We look for a PD array in the direction of the weekly range bias, premium PD arrays when bullish, and discount arrays when bearish. We anticipate price to move to a PD array that would support our weekly bias on a day and economic calendar event found on the economic calendar with the current or next trading week. This is what we're waiting for. Every time we sit down in front of the charts, we have that in mind. We're not looking for something to magically pop up. We're going in looking for something that would fit that narrative. If it doesn't present itself, then we have no trade. Now, this can either be a run on liquidity or a rebalancing of inefficiency in price. Opportunity discovery, identifying the discount arrays under Tuesday's European opening price. inside the 20-day IPTA data range when the bias is bullish. We identify the premium arrays above Tuesday's European Open inside the 20-day IPTA data range when the bias is bearish. We identify the discount arrays under the Wednesday's European opening price inside the 20-day IPTA data range when the bias is bullish. And we identify the premium arrays above the Wednesday's European opening price inside the 20-day IPTA data range when the bias is bearish. Now, what am I stating here? If the signal or setup doesn't form on a Tuesday, we still would consider it on a Wednesday. All right, trade planning. When the market is primed, we want to look for a convergence of both manipulation in price opposite to our trade bias at a time that the economic calendar suggests a volatility injection will likely unfold. What we're looking for is some snappy, sharp price movement that would be in the opposite direction, trading into our predetermined level of entry. Basically a Judas swing. Okay, so we're going through a period of market protraction that's opposed to our trade direction moving in profit. So in other words, we want to see it shoot up when we're looking to go short, and we want to see it shoot down when we want to go long. We're not chasing price. We will short above the European opening price and buy below the European opening price. When we are bearish, we will frame a short entry when the price has moved up into a 15-minute premium PD array that converges with a standard deviation of no more than 3 standard deviations. Now, the +3 there indicates that if you're using the Asian range, if you're using the central bank dealers range, or if you're using flout, you're only going up 3 standard deviations, nothing higher than that for your entry. During London Open or New York Open, the setup will typically form. The market will likely create the weekly low during the Thursday New York session. For a time filter and targeting purposes, we will anticipate the trade to pan out until that time. When we are bullish, we will frame a long entry when price has moved down into a 15-minute discount PD array that converges with a standard deviation of no more than 3 standard deviations lower. So in other words, we would look at nothing lower than 3 Asian range standard deviations projected lower, or 3 central bank dealers range projected lower, or 3 flout levels lower during London Open or New York Open. The market will likely create the weekly high during the Thursday New York session. For time filter and targeting purposes, we will anticipate the trade to pan out until that time. When we are bearish, we will target the sell side liquidity below an old daily low or fair value gap inside the 20-day IPTA data range, converging with a negative or projected lower standard deviation. What am I saying there? If we're short, or if we're getting ready to take a short, what is our targets? We're trying to predict the Thursday or sooner range that would offer 50 to 100 pips. Our target has to be in the form of a discount array if we're bearish, and we're looking for a standard deviation lower that converges both with standard deviation level and the discount array within a 5 pip variance. The immediate or next logical discount array will be the initial objective. There will likely be multiple old daily lows inside the IPTA data range, but we will use the one that frames the potential for at least 50 to 100 pips. When we are bullish, we will target the buy-side liquidity above an old daily high or fair value gap inside of the 20-day IPTA data range, converging with a standard deviation above. In other words, we're looking for a premium standard deviation. The immediate or next logical premium array will be the initial objective. There will likely be multiple daily highs inside of the if the data range, but we will use the one that frames the potential for at least 50 to 100 pips. Trade executions. When we are bullish, we will note the European opening price on Tuesday and filter all longs at or below this price level. We will anticipate a 15-minute optimal trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop raid. When we are bullish, we will note the Asian range high on Tuesday and place a buy stop at this level plus 1 pip after 2 a.m. Eastern Standard Time. Now, this is an alternative trade execution. This is basically buying strength. So, in essence, you aren't technically chasing price, because what we're doing is after 2 o'clock in the morning, the assumption is that we have already seen price drop down. Instead of waiting for price to potentially go lower and give us a loss by trying to catch the low, we can just simply use the Asian range high, put a buy stop there, and let it go. Let it buy us into the move with strength. But it has to be done after 2 a.m. So at 2 a.m. when price starts to drop down, if you're still learning how to project the low of the day, you can get your order in the event. Once it turns around, starts to go higher, you'll let the market seek its own low, and then you'll buy the breakout of the Asian range high. We will anticipate price to have made the low of the day after price starts its decline under the Asian range low and or European opening price. When we are bearish, we will note the European opening price on Tuesday and filter all shorts at or above this price level. We will anticipate a 15-minute chart optimal trade entry to form inside of the retracement higher during London Open and or New York Open and kill zones, or a buy stop raid. Okay, the alternative trade execution when we're bearish, we will note the Asian range low on Tuesday and place a sell stop at this level minus 1 pip after 2 a.m. Eastern Standard Time. We will anticipate a price to have made a high of the day after price starts its ascent above the Asian range high and or European opening price. Now, if we do not get a setup on Tuesday, the things that I've mentioned here for alternative trade executions for both bullish and in this slide here, bearish, would be the same thing for Wednesday. So we would be using Wednesday's European opening price. So everything we would see here that says Tuesday, we would just replace Tuesday with Wednesday and just repeat the same process. Short trade management. When we are entering a short, we will place a sell limit order on all positions we will execute on with our demo account. We will use the standard deviation and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit orders. When we are entering a short, we will place a limit order to take 50 pips as our objective on one position. We will place a second limit order to take 75 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 100 pip objective, close the trade and be content. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 25 pips. We will not re-enter if the trade stops out. We can monitor it for experience, but no re-entry is taken. One and done. Long trade management. When we are entering a long, we will place a buy limit order on all positions we will execute on a demo account. We will use standard deviation and PD array convergence plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all use the same entry price in the buy limit order. When we are entering a long, we will place a limit order to take 50 pips out as our objective on one position. We will place a second limit order to take 75 pips out, our second objective. We will use multiple orders to manage the trade idea. If you capture a 100 pip objective, collapse the trade and be content. When we are entering along, we will note the discount array and standard deviation conversions we aim to enter at. We will place a stop loss below this low minus 25 pips. We will not re-enter if the trade stops out. We can monitor it for experience, but no re-entry is taken. One and done. When we are in profit 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit 50% of our expected objective, stop loss can be reduced by 50%. When the position is at 75% of the expected profit objective, stop must be at break-even or above it. Money management. Position size calculation formula. Now, to determine your position size, it's the account equity times R% divided by stop loss in pips. Now, position size is the amount of leverage your trade assumes. Account equity is the total amount in your trading account. R% is the percentage of risk you're willing to take on per trade. And the difference between the entry price and your stop loss is the number of pips you'll use to divide for the result of the equity times R%. Okay, as an example, account equity, $20,000. Risk per trade, 1.5%, or $20,000 times 1.5% equals $300 US. The stop required for the trade, in this case, would be 20 pips. In micro lots, 1K each is 10 cents per pip. 20 pips times 10 cents is $2. And $300 total risk divided by $2 per pip would give us the ability to trade 150 micro lots per trade, or 1.5% of the account equity. Always round down. Okay, same equity size, $20,000, and the risk per trade, 1.5%, or 20,000 times 1.5%, $300. Stop required for this is 20 pips. In mini lots, it's 10K each, or $1 per pip. So our 20 pip stop times $1 per pip, it means $20 is our total risk exposure using 20 pips with $1 per pip leverage. So if our total risk assumption is $300, we're dividing that $20, which would give us 15 mini lots per trade, or 1.5% risk of the account equity. Always round down. In standard lots, 100K each is $10 per pip. So if we have a 20 pip stop loss in expectation, we would have 20 pips at $10, or $200 total risk. So if we had total of $200 per risk divided by $300, we can only do 1.5 standard lots, or 1 lot per trade. Always round down. Mini lots are more flexible. Now, right away, you can see with the model that I've outlined here in the trade plan, we're using a stop loss suggestion of 25 pips. So you would change the stop required to 25 pips, and all of the math here would change. It's not complicated math. It's just you're changing the 20 in this example here to 25, and everything would work out for your math to determine what your exposure would be. If your demo account takes a loss on a trade and it is a full R% that you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% again until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. All right, so what you're going to be doing is the same thing you did in model number 1. You're going to be collecting a month or two of sample sets with this trade plan. It's not hard to go through your price action and to see where these price moves have occurred. And if you're unclear about some of the process here, rewatch the lessons on this price action model and the supportive lessons in the core content.
All right, folks, welcome back. This is model number 2, algorithmic theory. And I'm going to be changing gears a little bit. Obviously, I've removed a lot of people over the years and in recent months because of either selling, being disruptive, or breaking our terms of use. So naturally, their way of trying to get back at me is leaking my content. But that's okay. It's not going to hurt me. So they changed the gears that I'm going to be doing is instead of spending all my time typing out slides and making it easy for everybody just to go out and share that or sell it or whatever they do, or put them in books and they try to sell them on Amazon, and I've already taken down 5 or 6 of those books. It's unbelievable, the blatant disregard for copyright infringement and intellectual property rights and things. But hey, I understand things around the world right now are rough, but I'm going to be teaching basically like a college professor. So I'm going to be speaking, and it's your job to write it all down. I'm going to show you visually in the chart, walking you through the steps, and these steps can be reduced down to the back of a business card. Okay? The logic that goes into these models, when it's spelled out, obviously, every minute detail wouldn't fit on the back of a business card. But the processes and procedures that get you to the main points of focus, application, and where you utilize certain things and what you're looking for, those are obviously understood because of your experience and understanding with the teachings in the core content. But I'm literally going to go into this Eurodollar chart and walk you through something I outlined beforehand, so that way it's not me going back and form-fitting it, so that way it sounds and looks pretty for you. It is the very basis of what I was utilizing for the analysis that I gave in the commentary this past Monday. Okay, so that way you know what I'm looking at in regards to the tools, because I'm going to spell it out for you. I'm using the algorithm that's outlined for model number 2, and I'm going to incorporate the alternative approaches as well that I outlined in the trading plan version. Okay, so you're going to see how looking at it from the video production and typing it out, it gets real easy to get lost in all those details. And I know it's hard, okay? But I think you'll like this approach better because it's literally me going in using what was already described, and you get to see whether or not this stuff really works. Because I've had people shake their fist at me and say, these models don't work. They absolutely work. But unfortunately, I think laziness plagues a lot of individuals that have that mindset. Okay, so I'm going to dispel all that today, and again, bring you more evidence to the fact that these things absolutely do work. All right, so right away, this model really hinges on what the majority of the models do, is what is the weekly range going to do? So the first thing we're doing is looking at a weekly chart. So we're just going to zoom in here in the most recent time frame here of candles. Scrub back here. Now, obviously, this is the week that just closed, and today is the 9th of April, 2022. So it's a Saturday. I'm producing this video. And this was last week's trading. All right, so the question is going to be, is the very next candle, which is obviously right here. Now, before we go any further, okay, just remember what I have been stating in live commentaries before it happens. We have been bullish dollar and bearish euro dollar. Now, I do not take you into the weekly charts in the commentaries. That's your job. Okay, I'm not going to do everything for you. I'm not going to lay it in your lap. I'm not going to spoon feed you because that builds codependency. But I want you to understand what the backdrop was behind the scenes, why I'm calling these moves and opinions, if you will, in the commentary. On Monday, in the commentary for Eurodollar, I gave a very specific expectation and we were bearish. We'll revisit that as we get to that point in this lecture, but I want you to watch what I'm doing and listen. Take notes. All right, so the very next candle here, obviously with the benefit of hindsight, it was bearish, which is what we were looking for. Why was this candle, in my mind, and proof with the commentaries, expected to be a lower candle or expand lower? Well, dollar's been bullish, obviously. We've been looking for it to go to the full 100 level. But look what we have here. Volume imbalance. See that? We have all of this range here is just on a tail of that candle, and all of this here is the wick of this candle. So there's really no bodies up there. So we traded up into it once more here, when bearish on euro, when bullish on dollar, and I've been trying to take everyone's attention down into that short-term low right there. So this is where we've been focusing. So now, the way you use Model 2 is you start by going back. So you look at the 20-day IPTA data range look back period of 20 days to find your discount arrays. All right, so this is the candle that you would be doing the analysis because this is the week that hasn't really formed yet. So we're using a hypothetical, but it was rooted in actually me calling it before it happened. So let's make sure we understand that. But you would be looking at everything on this calendar week before the new week begins on Sunday. So in other words, we're imagining, if you will, the candle hasn't formed yet, so it would look like that. So you would go back. Obviously, this is 5 days, 10, 15, 20. So what's the lowest low in the last 20 days? Right here. So that's why I'm focusing your attention there. That's why I've been talking about it in the commentaries. And I mentioned that we were looking for lower prices. Now we traded up into this volume imbalance. It's a premium array. From this range high to this range low. Why am I referring to that? Because this is the most recent decline. This is where it stopped and started retracing. We're bearish. So it's retracing back up into this range. Where's it retracing to? It's retracing back up into the volume imbalance. It traded up into it, and we're expecting higher prices in dollar, and we're expecting lower prices in foreign currency, euro, cable, respectively. So we're expecting lower prices in the next weekly candle to expand lower and work towards this low. Okay. Now, there are several discount arrays that we're going to be looking for. So we have to look for, with this model, it's engineered for capturing 50 to 100 pips. Once you get 100 pips, you're done. Okay, you're absolutely done. It also has time elements to a specific day of the week, and we'll talk about that when we get to it. But we're looking at this swing low down here. So right away, we're going to go through and mark off there is the rejection block here. And we're going to get a measurement on the consequent encroachment of that tail. Okay. And what I'm doing is I'm measuring the 50 level between the open of that candle and the low. All right, and I'll change this to be a slightly different color. All right. And obviously the very low. I'll use that down there, and we'll make that just dark blue. And the rejection block, we'll make that a dashed line with that much weight to the level. So that'd be before I drop down to the daily chart. I want you to take a second look at what these levels are, okay? These are our discount arrays. It's the old low rejection block. It is the consequent encroachment of the lowest candle's tail, that little line that makes the, these are called tails. They're wicks above the candle, but it's tails underneath them. So that price level at the open to the low, we're measuring that range and getting 50% of that. That's the gap. And this is the old low here. So there's our 3 discount arrays that we're aiming for or utilizing with the weekly range. Where could it expand down to? This is what we're looking for. Okay. So now we're going to drop into a daily chart. Now, obviously, it's going to take me more time to talk about everything I'm doing than it would be for you to actually just go through the process of actually doing all these things. So there's rejection block, consequent encroachment of the weekly candle tail, and then the old low, which is what we're aiming for. That's always what? Best case scenario. But do we need best case scenario to be profitable? No. Okay. So now what we're looking for is the logic behind all these moves lower here. So here's Friday's trading, Thursday's trading, Wednesday, Tuesday, and Monday. Okay, so April 4th, 2022, Tuesday, Wednesday, Thursday, and then Friday, right? So there were several things that I looked at and outlined for you. But before we get into this, this is Thursday. Just remember that Thursday is the day of the week that we have to close based on time. It doesn't matter where you are with the trade. Okay, if it's more than 50 pips, you close it. Okay, if you ever get to 100 pips, even if you do not have time to hold till Thursday, New York Open is where you close the trade for this model. So it will leave pips on the table. It will, unfortunately, sometimes get you out before a bigger move that takes place on Thursday and maybe into Friday. But the point of this model is for you to have a short-term trading approach to build on, because you can obviously tweak this and work with that Thursday time element and remove it if it works for you to hold on to it until Friday, New York Open. Something to that effect. It's something for you to figure out on your own. So there's that flexibility that makes it unique for you. But I don't want to talk about the fact that we mentioned that it could trade up into that area here and then sell off again. I mentioned that and it delivered. What I'm showing you here is this model, which is framed on Tuesday and Wednesday. Okay, so we're going to be using Tuesday and Wednesday's approach. So we'll drop down into an hourly chart. All right, and here is the Monday, April 4th, 2022, right here. And I mentioned in the recording Monday night's commentary. Go back and watch the commentary for April 4th, 2022. You'll hear me talk about how it's likely to go up into this imbalance here and then sell off. And we're looking for it to run towards that old daily low. Now, your objective is, when I give you these commentaries, is to go through and do what I'm about to do right here. And if you haven't been doing it like this, hopefully this will inspire you to do it, because you'll see what you've been missing all this time. All right, so let's stretch this out a little bit. All right, so we have on the hourly chart, going top down, there is our imbalance. I'll shade that right there. It didn't get dark enough for my liking, so there you go. And that is Tuesday's trading, April 5th. Okay. So right away, we have an imbalance here. So now we got to drop down into a 15-minute time frame. I'm not going to edit any of this out. You're going to have to suffer through it. If I got to suffer to get this thing lined up, you're going to suffer watching me do it because this is what you got to go through. All right, so we have the imbalance here. Now, as it was outlined on Monday night, before it happened, before it runs up into that, okay, once it starts having its market protraction on the upside on the 5th, you're going to be looking at the dealing range between that high here. Why that high? Why not something higher back there? Because this is the one just before the imbalance. This is the one that starts to decline, and this is the lowest low prior to it running back up into that imbalance. Okay, so the fair value gap, sell side imbalance, buy side inefficiency that's being shown on the hourly chart here. The dealing range that's parent to that is this high to that low. Okay, so we have optimal trade entry levels in here. Not sure why I don't have the 60 level in that. I'm going to change that 70 level right here. There you go. So 62 to 79% retracement level. There's your optimal trade entry. So here we have another element of price. It's going to drive me nuts, isn't it? Okay, that'll be good enough for government work. Right there, and we'll shade that. And I'm only doing this so that way you can visually see. That's probably not the best of it. That's good, yeah. All right, so this is optimal trade entry in terms of price range and inside of that hourly imbalance. So overlapping elements of price. But now we have to go into the most important factor, which is time. So we're going to drop down into the 5-minute chart. Okay, so here is the midnight candle at April 5th, transition from Monday into Tuesday's trading. We're going to delineate, make this a different color here, and then drop this back to 8 o'clock. Okay, so there is our Asian range. And with this model, obviously we're bearish. We are looking at a selling opportunity on Tuesday and or Wednesday. So if we get a trade on Tuesday, we don't trade on Wednesday. But if we don't get a trade on Tuesday, we look to do it on Wednesday. But there has to be consolidation on Tuesday, and it hasn't yet moved lower for that to be considered. Okay, so we have some filtering there as well. But we have the Asian range here, and I'm going to show you standard deviation here. I'm going to do both on the wicks and tails. Wicks and tails. That's the largest range that's been utilized for Asian range. And I know it looks busy right now, but I promise it'll make a whole lot more sense in a second. Once you do this a few times, you'll know what you're looking for, and it's not that big of a deal. All right, so this model has a filter that you cannot take anything as a short greater than 3 standard deviations above if you're going short. Okay, so Asian range, we're using that as our basis for standard deviation projections. So this is 1 standard deviation, 2, and 3. So right away, we have this level here. I know it's 1 pip off. It's going to be enough for me, though, because it's going to drive me crazy. So we're looking for a premium array no higher than that if we're using the Asian range, using the tails to wicks. Now, if we do it with the bodies of the candles, which is generally what I like to prefer over the wicks and tails because it's a little bit truer in terms of the volume. Right away, we can see that there's 3 standard deviations right there. Now, you can do this 2 ways. The way I just did it, which is generally how I usually do it, or you can do it the opposite way. You can go in and do the standard deviations on the Asian range, or you can use flout, or you can use the central bank dealers range. Whichever one you prefer, whichever one you adopt as your model. These standard deviations, you don't want to go anything higher than 3 standard deviations to look for your premium array because we're bearish. Okay, so this is your filter in terms of price. You can't go any higher than this. So right away, now I've done the wicks to tails and I've done the bodies, highest open or close to lowest open or close. That's what's being represented here. So I can take this off, get some of this busyness off the chart. And right away, you can see that the optimal trade entry here, relative to the dealing range high and the low that I outlined, that does not violate either the wick to tail or highest open or close to lowest open or close standard deviation of 3. So notice that. So this is in agreement with the rules. It's inside the dealing range from here to here. It runs above this short-term high where buy-side liquidity will be resting. So it runs up into that. Now, because we have the elements of price and we ferreted out what we're looking for in terms of the range, where should we be scanning or stalking for this very specific price range that we're going to be trying to trade on? We've already done that here. So now I can take this off and clean the chart up even more here. And now it's just a matter of moving this to the kill zone, which is 2 o'clock in the morning. Now, obviously, this would all be done before the market starts trading and creating all these candles in here. This is what you would have beforehand. And then you project it up to 5 o'clock in the morning. And again, this is rooted on the 62% retracement level, and this is 79% retracement level. 79 is outside of the imbalance. Notice that? See that? So what we could do is go over inside this range. What PD array, it's a premium array, is in agreement with this optimal trade entry price range and inside that time window of the London Open. What's this? You have a city in the form of a fair value gap right there. It breaks lower after running a short-term high. It breaks lower. We have an imbalance near the upper end of the hourly imbalance, which is that pink shaded area. So we can take that off. That's been incorporated here. And we know that the market's drawing higher into a optimal trade entry here. And also, the lowest band or level of that optimal trade entry, your 62% retracement level, what agrees with that lower end? So we have the optimal trade entry, a run above a short-term high. This candle's high here comes in at 98,888. The high on this candle comes in at 98,807. Okay, so it's 1 pip that below. You're going to be doing 5 pips below because you got to factor in spread. If you're looking for this level to get in, ideally, that's the lowest easy objective for a premium array, you would be 5 pips below that price level. So it would be 83.8. So let's do that. I know, I could just as easily just type that out, right? 83.8. So that would be your entry on a limit. Okay. Now using this, once you have the range you're looking for optimal trade entry, your entry for limit purposes, because you want to sell a little bit early because the spread has to be incorporated. We're using 5 pips spread, and we're allowing for this much movement here. Now, if you're entering with the premium array when bearish, after it's ran up into all the factors that I've went through from top down, you're going to use a 25 pip stop loss. It'll be a 50 pip stop loss if you use the alternative entry, which I'll show you again in a second. So 25 pips plus 83. So 10 would be 93, 103, so 108.9. All right, so that would be your risk on the trade there. Okay, so we can take this off. We have framed the idea here. And that is the risk during the London Open Kill Zone entry. And what we're going to do now, and again, this would all be done before the price even trades up here, while it's all doing this, okay? Now you're going to take the Asian range and do standard deviations to the downside. You're going to get both measurements. You're going to get the wick to tail, and you're also going to do 100 pips. So this is your entry at that level there. So 83.8. And that should be $100 pips. Okay, and that's the range that we're looking for best case scenario on this model. Okay, so 100 pips from entry. This is the rejection block. Remember that dashed line from the weekly? And notice how it reaches into that old rejection block with 100 pips right there. That by itself, my friends and neighbors, is very, very tight in terms of clustering. If we look at the price level here, 86 even, and it's 83.8 down here. That's the low. Is that less than 5 pips? Yes, it is, friends and neighbors. So now we're going to go into this measurement on the bodies of the candle, the highest up close or opening to the lowest opening or close. Okay, I just want to double check the close on that candle. 679 open here. 679. Open 679, close 679. Okay, so that's the actual range. Now we can go back out and see if there's any standard deviation that lines up closest to that 100% projection in terms of the model, and a standard deviation that is within 5 pips. All right, so we have $1.0891. That one is just, in my mind, it's not that good because it's over 5 pips. We have the rejection block, which by nature is what we look for to trade through that. So what are we doing? We're expecting it to trade down below the rejection block. So what would be the next standard deviation below the rejection block? With volatility being what it should be in the direction of our weekly expansion, we're looking for it to trade lower. We're not trying to limit the weekly range to 100 pips, but we're anticipating a target that all these things that I've taught you align with. The next objective would be 1.0881.5. So that level there. We'll use that as our objective, and we'll change that to a dashed line. Okay, and I'll thicken it up because I want it to be much more pronounced versus this rejection block. Now, let's go back out to a 15-minute time frame. So we have price trading into that level here on the 6th. So Tuesday's trading, Wednesday's trading, it trades into it there. And then the rest of the week, we consolidate it and then once more down in there. So we have 100 pips from entry here, clustered with a standard deviation, -9. So this particular day, right there, you're getting your 100 pips on that move. Now, you're going to aim for this, obviously, but your target fills sooner because the model says once you get 100 pips, you're out. You're done. Does it move much more than 100 pips from your entry up here? No. So you're going to lose sleep over that? I wouldn't. Now, if we look at that in terms of the day of the week, here's Tuesday, Wednesday, and you have to be out of the market on Thursday at New York Open. And it went a little bit lower there that day, and then they had this reversal. And that was before New York Open. See that? So let's go back over here. And let's assume for a moment that you either missed this entry up here, or you want to use this model I'm showing you here, which is the European Open. So there's midnight. So now we're going to use 2 o'clock in the morning. So there's 2 o'clock in the morning, the opening price. Yeah, I'll just use this one because we're already done with it. Opening price there. So 2 o'clock in the morning, opening price. You want to be a seller above that opening price. But you have to be a short seller on a stop one pip below the Asian range. Like that sound effects? All right, so we have So midnight to 8 o'clock. Asian range low. Right there. Okay. At 2 o'clock in the morning, right there, your order cannot go in to sell on a stop until after 2 o'clock in the morning. So after 2 o'clock in the morning, you're looking for the market to create a short-term rally, which we're getting here. So once it starts to rally and it trades above the Asian range high over here, once that occurs, we're having what? Market protraction or Judas swing. So you may be fearful. How far can it go? I don't want to get into it and it stops me out. Okay? Like if you don't trust this part of it, which is in my mind the better way of doing it, but I understand some of you want confirmation. So after 2 o'clock in the morning, you're waiting for a rally to take out the Asian range high. Once it does that, after 2 o'clock, this is the time window element. So time is important here. You're looking at 2 o'clock, you're going to wait. Does it start to rally above the Asian range high? I don't have the Asian range high in here, but you obviously know it's above the Asian range low. So it starts to rally. So right away, we can then put a sell stop 1 pip below the Asian range low. Now, if you're going to use this as your entry technique, there's nothing wrong with it because you're selling weakness once the move has already established the intraday high. So we're going to say that's, let's make sure first, it should be 64.5. That would be your entry on a stop right there. So below the Asian range low. So you're not trying to guess how far it's going to go up. You don't care. But should your stop be filled, you have to use a 50 pip stop loss. So you'd get in on there, and then you would $10, $20, $30, $40, $50. This should be 5 right there. So here's your 50 pip stop loss. So you're selling short. Scrunch this up so you can get a visual of what's actually occurring here. Hopefully I haven't lost you. It's rallying at 2 o'clock in the morning. You're waiting for it to rally. Once it takes out the Asian range high, and let me just put that in now because it'll make better sense now that I have it dressed up like this. Once you do this on your own charts, it'll be much more meaningful to you because you'll be able to put the price action axis and time. You'll put the charts the way it looks nicer to you instead of how I have it. I know what I'm looking for, but this might not be so aesthetically pleasing to you at the moment, but I promise in a second it will be nice. And then the Asian range high here after 2 o'clock, right here, you're waiting for it to rally above the Asian range high. Once it does that, you're putting a stop on to sell stop as the entry. So you're not really buying anything and putting a sell stop below to protect anything. You're placing a sell stop at that price level. Once this Asian range high is taken out, once it trades above it, it's it. So you have to wait post 2 o'clock in the morning here. Asian range high is taken out. You can put a sell stop down here. And that way you don't have to guess how far it's going to go up. And it'll only put you in once it starts to go down. Once it breaks the Asian range low, which it does here, you have a 50 pip stop loss. You're filled right on that candle right here. Or you should be. Let's see what the low is on that. 62.3. Yeah, you should. I mean, depending on what your broker is. You know, if they're fickle, they may not fill you there. But you get filled here for sure. And once that fill is done, even if you got filled here, you're not even getting half of the stop exposure with this retracement higher. It spends some time in here, but you're sleeping. Once you put your order in, you put your stop in, and your limit order in down here at 100 pips, you're done. You just let it do what it's going to do. It's either going to stop you out or it's going to hit your objective down here. Now, you can put 2 orders in. You can put one short on a stop, selling at 109.65.4 with a stop loss up to 110.14.4. So that would be your 50 pip stop loss, excuse me. And then that one contract or lot, standard lot, whatever you're trading, mini, micro, whatever, would come off at 100 pips. And then the second order, so you would place 2 orders, because that's what this model is calling for. Your second order, you're getting out at 50 pips. So you're going to take 50 pips off on one of the standard lot, micro lot, mini lot, whatever it is you're using, and then you're holding the second one until it gets down to hopefully 100 pips. So both of them would have been filled. And you can see this was the result. So it fills you here. You never even make it to Thursday. But had it not filled it on this, your drop down, it would have happened here. If it wouldn't have happened at all, say it consolidated longer, you would have been filled here on Thursday, early morning before New York opened, and you never would have suffered any of that drawdown back into and maybe even stopping you out. Now, once you move 25, the way you do your stop loss is real easy to remember this, by the way. My stop loss protocol managing the trailing stop loss is 25, 50, 75. Okay? It's 25% of what you expect to see in profit. If it starts to see that, like right here, your stop loss can drop 25%. If it drops down in your favor and you're making 50% of your expected profit objective, your stop loss drops 50%. And then once it drops to 75% of what you're expected to make in your profit, your stop has to be at break even. It never, ever, ever comes close to break even. But that's the protocol for stop loss management. Okay. So I've literally taken you through model number 2. I broke down how you could have applied it to this actual event. We called euro lower. I gave you a very specific element of entering on the 5th based on the 4th's commentary. This movement up in here, that was that hourly imbalance. Let's go back up to the hourly. And this one will be done. All right. And right here. Go back and listen to the commentary on the 4th. And you'll see me refer to how on the 15-minute time frame, I believe it's what I was looking at, I said that we were likely to go up into that, and it's based on the hourly. So one of the things that I know some of you want me to do is be highly, highly, highly detailed about everything and why I'm outlining it. The reason why I'm not doing so much of that when I'm giving the commentary, number one, the videos will be very, very long. And 2, there are some of you in here that are just basically parroting what I'm saying because you're selling my analysis as your own. So I'm not providing you all of that stuff to make you look even better. And I know some of you might not like that you aren't doing that, but you're like, oh, but you're keeping it from us. I'm not keeping anything from you. These are the things you're supposed to be doing anyway. I promised in the commentaries that I was going to point to where the market's likely to go. I hint at where it likely could draw up into or down into to set up another setup to go where I'm pointing to. So I'm already doing all the leg work for you. It's your job to go in and do the things like I just did here using model number 2. Okay, so hopefully this has been insightful to you. And until I talk to you in model number 3, I can't really say that. I mean, think about it. I'm going to be doing each one of these once a month. So the next one we'll do it the second Saturday of May. Okay, so the second Saturday of May. Let's look at that. What that would be here. May, Saturday, the 14th of May. That will be when I do model number 3's algorithm lecture. Okay, so I literally walked you through the components, what you're doing, what it looks like, why are you doing it this way, what are you looking for, step by step, taking you right into the chart. It absolutely works. It's very, very precise. It's right out of what I explained, and it was explained years ago. So there's been some delay. Notice that? It ain't like, oh, well, we're going to find something that works. No, I just told you something this Monday. And if this would have been your approach, if you want to be a short-term trader, you don't have to be in front of the charts the whole time, monitoring and babysitting it. You can apply something like this. And it doesn't have to be just this. You can tweak it and fine-tune it with other things that you have grown accustomed to liking and drawn an affinity for, with other tools and other approaches and what you're looking for targets and such, and basically make it your own. So this was my submission for model number 2 for algorithmic theory, and actually taking you into the chart, and that's what we'll do when we do model number 3.